This is TreppWire Week in Review for week ending February 4th, 2022. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Hendry, Head of CRE and Advisory Services. This week, travel takes a hit as winter storms sweep across the U.S., and markets were rattled by Meta's disappointing Q4 earnings and outlook, as well as news that the Bank of England had raised its key rate. In economic data, private businesses shed jobs in January as Omicron slowed hiring and kept people home, and unemployment claims dropped last week, highlighting a tight labor market. Manus, many say that the jobs report expected out tomorrow will provide very little in the way of any clarity.
Thanks, Martha. There are a lot of parallels between last week and this week, although I would say that investors are looking at things with a much more level-headed eye than they did last week. If you recall, two pieces of bad news rattled the market considerably last week. One was kind of the hawkish tone of Fed Chair Powell's remarks after the two-day Fed meeting, which kind of sent stocks really plummeting in the next day or two after that. And we also saw just really dismal guidance from Netflix, which sent that stock down about 20%. And the combination of those things really sent the market into a tizzy. We saw the NASDAQ lose 5%, more than 5% from peak to trough in one session. We saw the Dow do about 1,200 points in one session. Over 2 days, the NASDAQ was down about 6%. Over 3 days, it was down 9%. So there was real panic in the air. If you move forward to this week, there are some similarities there, but there was a lack of panic. So from Friday to Tuesday, we saw a really buoyant rebound. The indexes were coming close to their all-time highs again. They had erased a lot of those losses from the Fed remarks and the Netflix sell-off. And then over the last couple of days, we saw, again, dismal earnings from a FANG stock. In this case, it's Facebook, which saw just awful numbers and incredible expenses. And its stock was down 26% at one point today. We also saw a very disappointing ADP number that you referred to. But even with that, even though the markets are lower today, there seems to be a lot less panic in the air. And maybe part of that is they saw, investors saw the market rebound so quickly after the last set of bad news that they're thinking, okay, this is going to kind of be a distant memory very quickly. So we'll see. But I have to think, one of these days we have to stop calling the FANG stocks something else. I don't know if we have to throw out the F and the N and now we're calling them ANG, or we have to get rid of the G and it's, because it's not Google anymore, it's Alphabet, and it's just the stocks. I don't know. We'll have to see, or it's Meta, so it's MANG, right? Maybe one of our listeners can come up with the precise new acronym for all of this. Lonnie, what did you see on your side?
Yeah, so very interesting. I think the Twitterverse, where I spent a lot of time, they had some interesting takes on some of the earnings. So with Alphabet's earnings, I saw a guy post on Twitter last night. The reason Google keeps printing money is because you're searching Google on their earnings. So it's like this built-in cash flow machine, right? You're always focused on looking at what Google says about everything. I think Zero Hedge had some pretty interesting comments this week that Facebook had lost more value than the market cap of 455 of the S&P 500 companies, and at one point was down 200 billion off of their the Meta's market cap and after hours trading. So all of this stuff is very interesting. I do think, though, as you mentioned, Manus, this week was a little more tempered approach. It'll be interesting to see what happens with Amazon and their reported earnings coming up, to see how the market reacts to that. I think another story that hasn't gotten a lot of attention, but probably will in the coming weeks, is the airline flight cancellations due to the snowstorm that's happened. I did an update for our company a few weeks ago talking about the 5G rollout with airports. And it was kind of a very Y2K feel of, if we turn on 5G at the airports, it's going to ground a lot of flights, and it was a non-event. But when the snowstorms come, that's not a non-event. And it looks like airlines canceled about 3,800 flights Thursday as a snowstorm moved across the Midwest down to Texas even. So it'll be interesting to see what happens with Amazon and how the market reacts to that.
We may get those numbers before we finish recording today, and if we do, we'll throw it in there. But Lonnie, since you brought up the Twitter thing, I wasn't going to bring this up so early in the podcast. I don't like to detour, right away, but I'm going to detour a little bit. We are podcasters, and after this week's Joe Rogan, Neil Young kerfuffle, I felt it was incumbent upon us, because we're in the arena, to talk about this, even just for a couple of minutes. I see Lonnie reaching for the antacids. That's not a good sign. But we're not going to get political here. We're not going to get political here. I'm just going to, because we don't like to do that. We're really just CRE guys. But, clearly, if we had gotten under Neil Young's skin, we don't have 10 million listeners a week. Spotify, I think, would have said, Trepp Pod, thanks, it's been a great run, but we're going to really have to stick with Neil on this whole thing. Right? We're not Joe Rogan out there. They wish us best wishes and we'd move on. But I was out with a listener this week, having a cup of coffee, and he asked me, and I thought this was hilarious, where on the entertainer continuum would Trepp fall? At what point would Spotify say, you so-and-so artist, Trepp is more important to us than you are, Billy Ray Cyrus, right? I mean, we do get 5,000 listeners a week at times. We've had 300,000 listens so far. So it's not, I think probably Joan Jett and Michael Bolton could probably still get us off Spotify. But, if we get down to the Baha Men or Vanilla Ice, people like that, or for the millennials, Gautier, right, with that horrible song from a couple of years ago, I think they would say, you know what, Vanilla Ice, we like these Trepp guys. We're going to keep them on Spotify. That's my observation for the week.
I'm going to hope that we could outlive a Vanilla Ice cancel culture campaign. If not, then I think we may have to rethink what we're doing here. It is interesting. We had a footnote here. Spotify technology stock fell 8% in pre-market trading after it issued guidance for the first quarter that pointed to a slowdown in subscriber growth. So, maybe bringing it back, man, it's like, as these things flare up in the media and as they become more mainstream, these companies have to really look at what the impact for those bottom line, dollars and cents are for them as a company. So I think Spotify's tried to navigate this in a very apolitical type of framework. And I know Joe Rogan came out and made an apology for making this such a huge ordeal and tried to calm everyone down. At the end of the day, I think they paid him, $100 million. So, I mean, you just got to follow the money on this one. If you and Martha negotiated a $100 million contract, I'd like to know, because I didn't get any of that. So if there's some residual laying around, I'm happy to take my part.
Well, I say all this tongue in cheek, but I do love our audience. We've said this many times before, and those numbers are real. We've had 300,000 listens since we started this early in the COVID time. We get tremendous engagement from our listener base with phone calls, emails, cups of coffee, and so forth. So even though I'm doing a little self-deprecation here, we really do appreciate everybody who's listening out there. And if you do feel like sending us a who would we trump on Spotify email and let us know where you think we would fall on that, D-list continuum, feel free. It might make for some hilarious feedback. Where would you put us, Lonnie? Come on. Or Martha.
What I was going to offer is, if we got a certain number of likes, I might do a Vanilla Ice lip sync that we could post on YouTube or something. Because I do know a little Ice Ice Baby. I can rock a little Ice Ice Baby.
We're going to need a disclaimer on this pod for going completely off the rails and adding zero value. But at least we're not putting people to sleep. So that's good. Moving on, the Trepp delinquency update is out. And Manus, we're going to walk through what we saw in January. The rate hit a post-pandemic low.
Yes, that's coming out to our broader audience, I think, on Friday. So the day after we release this pod, it will show about a 40% decline from the December numbers, which is terrific. If you remember our last month's numbers, we saw the first uptick in 18 months. We had hit a post-Great Financial Crisis high in June of 2020, 17 straight months of declines. Saw an uptick in December of 2021, driven largely by some very large office delinquencies. This month, we are back on the improving trail back into kind of the lowish 4% range, which is a post-pandemic low, as Martha said. Part of that was due to the fact that two of the big loans that went delinquent in December cured in January. So one was 245 Park Avenue in New York, one was 181 Madison in Chicago, but those assets are far from out of the woods. If you read our research last month, the reason they went delinquent was because the sponsor for the loan was affiliated with HNA, the big Chinese real estate conglomerate that has had liquidity issues and going concern issues. That affiliate filed for bankruptcy, which ultimately led to them not making a payment in December, and the loan went delinquent. They did cure in January, but until that bankruptcy is resolved in full, there could be some more reversions of delinquency numbers and so forth in the office space due to this. I'll give you some property by property type numbers. Industrial remains just a great performer, under 50 basis points now in terms of delinquencies. Really almost impossible to find distress in that area. Lodging down another 40 plus basis points. It's now in the low 8% range. Listeners will recall we were in the mid 20s range, 25, 26% at the worst. Multifamily remains under 2%. Office, with those couple of cures, is down now to about 2% as well. And in retail, distress continues to get squeezed out of the system. It fell below 8%, down about 30 basis points for the month. So by and large, a very good number, consistent with what we've seen for the last 18 months, and more evidence that the lodging and retail segments continue to heal.
Yeah, I think it's interesting, Manus. If you look at everything outside of lodging or retail, these aren't that far away from historical norms. So I think for industrial, multifamily, and office, if you looked at these numbers compared to anything, leading up to the pandemic, none of this would make any cause for concern. And lodging and retail definitely stabilized and started to come down. It will be interesting though, like that last maybe 5 or 6% to get down to their historical norms. I wonder how long that's going to take for the market to truly be, back to full recovery, at least as it pertains to lodging and retail.
So Manus, CMBS data is not the only thing that we look at and evaluate. We also have bank loan performance data. What does that look like?
Well, we don't talk about this a whole lot. Most of our data analysis is on the CMBS side, but we do have a team here at Trepp that collects bank balance sheet loan data. So we have contributors across the US that every quarter they give us their loan by loan portfolios for both CRE and CNI. And we database that, we anonymize it, and we come up with delinquency rates that people can compare and benchmark their own portfolios to those numbers that we have from this consortium of banks, and see how they're doing in terms of delinquency, risk rating, evolution, migration, et cetera. The head of that is Matt Anderson, and he really does a nice job every quarter coming up with an analysis of this. And it is something that we share. So if you haven't seen that and you'd like to, certainly reach out to us. Two takeaways from this data. Number one is that the comparison between CMBS and bank loans in terms of delinquency levels are just, that y-axis is nowhere close to what we're seeing in the CMBS side, right? CMBS, we're still in that, we were up 10% at one point, still above 4% here. In the taller side, which is the acronym we use for this data set that has hundreds of billions of dollars of loans, is between 1% and 2%. So it does show that difference between balance sheet lending and CMBS lending. And some of that may come from banks just being a little quicker on the trigger to give relief and having more latitude to give relief than the CMBS market does. The other headline that we would say about this is that retail as a category, as its delinquency level is getting squeezed out, in that segment, delinquencies in the taller set below considerably the CMBS data. But on the hotel side, the delinquency levels that we're seeing at bank loans is above what we're seeing in the CMBS side. So while the overall number for delinquency for banks, 1.5%, something like that versus 4 overall, and by most property types, better at the bank level than at the CMBS level. Hotel is a little bit slower to recover on the balance sheet side.
Yeah, I think it's interesting, man. It's on the balance sheet side for hotels. If you look at it by volume, it's a very small percentage of the loans they make. So they're not as familiar with them. There maybe is just some more inherent risk with them, which may lead to those loans maybe not coming back as quickly. But I think overall on the balance sheet side, lenders are in the relationship business and they have a lot of ways to work with borrowers and try to keep loans from becoming delinquent or showing up or progressing on the risk rating scale. Whereas in the structured universe that we track with the CMBS stuff, the covenants and everything are pretty rigid. So there's not a lot of leeway in terms of working through delinquency or pushing things out based on relationships. So I think it's important that we have a holistic view. We can provide that to our listeners, both from the taller data set and CMBS, but they're two very distinctive, lending markets and their ability to treat these things show up in the data sometimes.
So moving on to some property sector specifics, let's look at office first. And we're going to focus on Houston, a location that we've talked about before for mostly negative reasons, but we've got some good stories coming out of there.
Yeah, this set of segments, these next property segments, could be a little bit of potpourri. We try to put together themes for our podcast so people can look at. We have a couple of things that we've bundled, but we may go far afield over the next 15 minutes. But one thing we were able to bundle is, as Martha noticed, a lot of positive news coming out of Houston. Houston as a submarket has really been challenged in the office space for a long time. Ever since 2015, when oil fell below $30 a barrel, the major oil companies have reduced space. In some cases, they've moved out of offices, leaving full offices vacant. Enormous amounts of sublet space, lots of distress. We've seen some big losses there over time. So among the major cities, really one of the most challenged major metro areas. But this week, 3 good stories. One, we saw that multiple news outlets were reporting that Exxon would be moving its headquarters from Irving, Texas to Houston. That is a real green shoot for the Houston market. Exxon currently is located at 5959 Las Colinas Boulevard in Irving. Exxon owns that building and Exxon will put it on the market. So brokers, start your engines.
Yeah, so the news coming out of Irving that Exxon's going to be moving, selling that building and moving their corporate headquarters to Houston. I don't think this comes as a shock to anyone in the Dallas market. So Houston opened a new corporate campus in 2014. It's about 25 miles outside of downtown Houston, and it houses or is built to house up to 10,000 employees. So the new headquarters is a LEED Gold building. If you Google the headquarters and look at the images, it's really incredible. They have a huge, what they call a 10,000 ton floating cube that kind of welcomes you to the campus. They actually sold another building in Dallas in 2015. So Exxon and Mobil at the time had purchased a building from the Zales Corporation called Pegasus Park that was on 23 acres and was sold. So part of their downsizing. When they acquired XTO Energy around that same time period, they actually shuttered about 4 or 5 of their corporate buildings in Fort Worth, Texas, and moved all those employees to their Houston office. So, this has been something that's been part of an overall cost saving strategy, I think, for Exxon over the last few years. And they actually say this reorganization should yield about $6 billion in cost savings compared to 2019.
Yeah, I thought the takeaway from that story is the trend that indicates, which is companies are going to be optimizing their footprint in ways that make the most sense for where their workforce is and where they're going to be, right? So you have a number of firms that have now got hybrid workforces, people moving to other locations. And as you mentioned, Lonnie, this is part of an overall reorg that gives them significant cost savings.
So Lonnie, I'll throw a little curveball at you here since you're down in that neck of the woods in Texas. For the last decade or so, Texas, and particularly that Plano, McKinney, Irving, Dallas area has just been a magnet for corporate headquarters, bringing in companies from California and the upper Midwest and New York and so forth. Do you get the sense that Dallas is getting full and expensive, and that people are starting to say, it's time for look at number 2 and number 3 city in Texas, Houston or other places down there?
I think I would actually say no. I think on the whole, Dallas is still benefiting from relative affordability. So anyone looking to move from California, New York, or anywhere else, Dallas has international airport, it has rail systems, it has everything that you would need for a corporate hub. I think in this instance, it just made sense. Exxon has such a huge presence in Houston. They made a decision several years ago to relocate there. It just took time for them to wind down operations. But I think this is one of those stories where it could be a win-win. Because the Dallas office market is so hot, I don't think the 5959 Las Colinas that Exxon's vacating is going to be on the market for long. And they'll probably reposition that building to actually be more additive to the local Dallas economy. So I would say anywhere in Texas, I mean, our locally elected officials, they're touting, I think Texas has the 9th largest economy in the world by GDP. And I don't see any slowdown in that. And on a relative basis, the cost of living, the cost of office space, all of those things are still so affordable. It's going to be hard to beat. Now, is there maybe some urban sprawl from what we consider, urban core Dallas into some of these other markets? I think that's definitely real. With Jerry Jones putting the Cowboys out in Frisco, that really kind of cemented that suburban town into more of a real player from the CRE perspective. So I think you'll continue to see ebbs and flows as people, have maybe newer options in newer parts of the developed city. But on the whole, Dallas is going to be a destination city in my mind for some time to come.
A couple of other nice stories about Houston. We'll run through these quickly. One was that Skanska USA has sold West Memorial Place 1 and West Memorial Place 2 for $147 million. That story comes from the Houston Business Journal. That equates to about $205 per square foot for the 720,000 square foot complex. The buyer was Fuller Realty Interests. Another one we saw was a 3-building complex in Memorial City. The owner there was able to get Coterra Energy to sign a 120,000 square foot lease. That's at 3 Memorial City Plaza. And helped by that lease, the owners and the owner is Metro National, will embark on a $20 million update of that particular building. So you don't do a $20 million update on a building unless you're kind of believing in a market. And in this case, the owner of that building does. So 3 nice little green shoots for Houston. That second story was also courtesy of the Houston Business Journal.
You mentioned Houston really struggling with the office market when oil was down to $30 a barrel. Now that it's, inching closer and closer to 100. I kind of went back through our data and looked at the Houston office market cycle. So I pulled up properties that had been financed, call it from 2014 to say 2019, and looked at what those at issuance or at origination appraised values were per square foot. So for buildings over 100,000 square foot financed during that time period, the average appraised value per square foot at origination was about $144. So this most recent sale was announced at $205. Now, what's interesting is during the downturn, we had about 12 properties that were liquidated at a loss in CMBS, and the average liquidation price for those office buildings was $46.70. You fast forward to now, if you look at new issuance 2020 and 2021, the average appraised value during that time period for the same properties, Houston office, 100,000 square foot or larger, was $249 a square foot. So that market definitely is one of those feast or famine. But I'll say the folks that bought these properties at $46 a square foot during the crisis are probably feeling really good about their prospects. And I think the last story you just mentioned with the lease and putting $20 million in capital expenditures, those things happen and continue to grow the city. The investors that bought these buildings at a really low cost basis are going to be able to reposition these and probably make out really good in the next 5 to 10 years when they decide to exit.
So we've got a couple more stories in office, another green shoot, but it takes us to Omaha.
Yes, I think, Martha, you've told our audience before that you were once an Omahanian. Is that the right thing? Omahanic?
I don't think either of those work for me. But
sure
yes, I've lived there twice. It was so nice.
We saw a story this week that Mutual of Omaha will be developing a new headquarters in the downtown area near the library. It's going to be a 50-story tower, and it will challenge the First National Bank in that city for the biggest office in Omaha. And, why does this matter to me? Why did it catch my attention? It's that, insurance companies, I think, are ripe for not going back to the office, right? A lot of their processing and other things can be done remotely, but here is Mutual Omaha making a bet on that, getting back to office. So another green shoot of sorts there.
I just have one question to ask. Do you really have a downtown when your headline says downtown Omaha near the library? I'm not sure if that really qualifies for having a downtown.
It is, and where they're moving. I mean, Mutual of Omaha has an office around the 30s, which is kind of closer to Midtown. So the urban center is where Old Market is, and some other locations. I think Union Pacific is down there. So yeah, they're trying to lure people closer to what's considered the urban core there, if there is such a thing.
Well, Martha wouldn't be where she is today without spending a lot of time at that library, Lonnie. So
I think that was a compliment. So moving on, we've got some Crabgrass that take us mostly to some St. Louis locations and others.
So yeah, we'll try to bucket these two right there. We talked about Houston being a very challenged market. St. Louis is also very challenged. We've seen a lot of situations there. One is, I think it's that AT&T building that once backed a $125 million CMBS loan. The property was valued at, I'm guessing about $170 million at one time. The sole tenant left. They've tried 5 or 6 times to sell this thing. If you wanted it, you could probably buy it with your petty cash right now. I think the property is being marketed for $5 million. Like I said, they've had 4 or 5 or 6 failed acquisitions there. And there are several properties in that area that just have fallen into that narrative of big exposure to one tenant leaves, building is dated, needs a lot of money, value decline. So I'll go through 2 stories. The first one is last year, US Bank sold its 660,000 square foot tower. At the time, the price was not revealed. Last week, or maybe it was early this week, Gloria Lloyd of the St. Louis Business Journal reported that US Bank only got $61 a square foot for that tower. And it's even worse than that, because the buyer not only got the US Bank tower, they also got a nearby property, 721 Locust. So the $61 a square foot that I quoted was only on the tower side of it. So that's valuing the 721 Locust for nothing. So if you were to kind of throw that in there, you're probably talking about a sales price in the 50s. And that's just such a terrible benchmark for that market. However, later in the week, Ms. Lloyd came back with a better benchmark. 700 Market Street was sold to Arch Street Capital and Orion Office REIT for $239 per square foot. So that's, a greener shoot than that US Bank Tower number.
Yeah, I think US Bank Tower maybe solidifies our position that these Class B and C office buildings are really going to struggle. And so to your point, Manus, if you're relying on 1 or 2 tenants to cover your debt service and they leave in some of these markets, it's going to be really hard to replace those tenants if you can. And if not, you're going to be selling at, basement bargain type of pricing. $61 a square foot for an office tower is unheard of. And it's disheartening. St. Louis has a lot of really great things going for it, but the commercial real estate market there for the last 5 or so years has really been struggling with a couple of these large, single tenant assets just not being able to be repositioned in the marketplace.
Yeah, if you look at the biggest losses we've ever seen in the CMBS market, malls would make up a big percentage of those. When you're talking about losses that go above $50 million, or even those, $100 million loss numbers where you saw a mall with a $120 million balance, resolve with a $105 million loss. That happens. But there's been a dozen or 2 dozen of these things that have come from these campuses, like to SBC, which was another telecom company, AT&T, which had a big campus outside of Chicago. I think it was Office Max outside of Chicago, AT&T in St. Louis, as we mentioned. When you see these losses get above $50 million in the office space, it's almost always what we're talking about. Huge tenant in Houston, going back to that city, we saw properties where they had BP and Conoco as the two sole tenants. They both leave, and that becomes a distressed situation. They also had Waste Management headquarters, which is yet to be resolved, but that building is 100% vacant now. If you're looking at risk, if you're a novice, old guys like me know that these assets come with risks. But for newer people to the industry, if you're going to see the opposite of a four-bagger, I guess that golden sombrero where you strike out 4 times in a single game in the office space, it's going to be the kind of things we're describing.
So moving on to retail, we saw some news around the mall REIT known as PREIT, which invests in shopping centers in the mid-Atlantic states.
Yeah, we had a couple of green shoots this week, PREIT being one of them. In the mall space, in the mall REIT space, you have, the all-stars when it comes to having those, Class A malls that are just generating hundreds of dollars a square foot in sales above what you get for the B's and C's, and the all-star team would be Simon and Brookfield. And then you have a lot of other guys that are just trying to grind it out. In that you would see CBL that had to file for bankruptcy last year, Washington Prime, Pyramid, and PREIT is in that category where they're not in that Mall of America stratosphere by and large for the assets that they own, and it's a harder way to make a living. You're borrowing at much higher costs, and you're generating a lower number on the revenue side in terms of dollars per square foot. But there was a story this week that said PREIT sales per square foot topped $600 on average for the trailing 12 months. That's a really good green shoot. When people talk about malls failing, it's usually when that sales per square foot drops below $350 a square foot. And it's at that, some people think it's 300, some people might say it's 400. Morgan Stanley put out research a couple of years ago. They called the Mall Mendoza line, I think 325 or something like that. But if you have $600 a square foot, you have some breathing room there. And of course, in the PREIT portfolio, there'll be some below that $600 line and some well above that $600 line. So they will probably have some properties that fail. But the fact that it's over $600 a square foot on average and is above 2019 levels is a very good sign.
Yeah, not to take too contrarian of a take on this, but to maybe bring a little bit of a different perspective, Manus. I would agree with you. I think the Mall Mendoza line, I think the 350, kind of threshold is valid. I think what we get a little bit, numb to is these average numbers. What I know is if Apple is a tenant in your space, especially in a mall, just that one Apple store presence can inflate your sales per square foot numbers to the tune of a couple $100 on the average, because they're so far outside of everyone else's stratosphere. So I didn't see in the PREIT announcement if these numbers were inclusive of Apple's store sales, or if they had made any type of adjustments for that. I actually, in the release, they had mentioned and called out one of the malls that we track, which was Patrick Henry Mall. So I went through and pulled up some information on it. It was a mall that was financed in 2015, original balance of about $96 million. At origination, the inline historical sales per square foot average for that mall was $405 a square foot. So if they bump that up to 600, I would take that as, fits the narrative of a really good thing. However, if you look at the financials, they were at 91% occupancy in 15, and the NOI at underwriting, first year post underwriting, was $10 million. Fast forward to their 2021 numbers on an annualized basis, their NOI is about $9.3 million. So their sales per square foot numbers maybe look good, but if you look at the performance at the mall, they're about 700,000 to the negative on the NOI line, even with 4% higher occupancy. And then there was a story by Seeking Alpha this week that talked about, maybe their debt load at the REIT level is going to be too burdensome for them. So I think they said their interest payments are killing the cash flow. Third quarter 2021 interest expense was about 45.2% of their third quarter revenue. So I don't know if you have any thoughts about that.
Well, I think that when you talk about any time of commercial real estate coming out of the pandemic, we're grading on a curve, right? So if we talk about, marginal sales increases, let's say at the destination hotel market, where things have been really great for a period of time, where people have been really selling out these hotels, right? If you're not taking part in that rally, right, it's a big yawn and you're disappointing. Here, so if some of these destination hotels were kind of putting up the growth numbers that PREIT was saying, we might say this is a non-story, right? They should have done better, but on the curve of the mall space, which, we're talking about, are these things going to continue? Will there be more bankruptcy filings? Will there be more deed and lieu's and keys being tossed back? When I read the thing, my first reaction was a positive one, but that is on a curve. And as you say, they do have a lot of corporate debt out there, and they will have malls out there that will remain challenged in the long haul. And there's no doubt about that. And that really goes for everybody that I mentioned in that whole category of Pyramid, CBL, Macerich, Washington Prime, et cetera, right? They will continue to try to muddle through for the next couple of years.
So turning to another area that has shown some positive signs, San Francisco, specifically the Union Square area.
Yeah, we wrote some really kind of concerned articles about that Westfield Mall area. We put out several news stories through TreppWire, I think probably December, January timeframe, 2 in a row. It's a mixed use complex, a lot of retail, some office. And we pointed out that occupancy was falling off. They had lost 2 major office tenants, and several retailers in that area had announced that they were closing. So we said this is a big asset to watch. And it was of a piece in San Francisco where you saw multiple Walgreens closing. You saw concerns about crime ticking up and so forth. And it was just kind of a downward spiral in terms of the negative for that narrative for that city. And it was also coming at a time where you saw similar types of stories for Rodeo Drive and the Mag Mile in Chicago and Madison Avenue in New York, and so forth. But we got 2 stories. Both of these were from Alex Barrera of the San Francisco Business Times. It's part of the Biz Journal set of publications, but he broke a couple stories this week, which were terrific. One was that Chanel was going to buy 340 Post Street in San Francisco in the Union Square area, I believe. I'm not that familiar with San Francisco, but for $3,500 a square foot. They're buying it from Stockdale Capital Partners. The price is, wait for it, 30% over the 2018 purchase price. So even with all this terrible narrative out there for San Francisco retail, the Stockdale guys were able to get a 30% premium on this. Chanel paying $63 million on a nearly 18,000 square foot, 3-story property there. But wait, there's more from Alex Barrera. Yves Saint Laurent plans a store in the Union Square neighborhood as well. They are also taking a 3-story footprint, 12,000 square feet in the old Magnin building in Union Square. And so here you have 2 votes of confidence coming in with premium prices, in my opinion, right? This is not replacing luxury with a Five Below or a drugstore. This is luxury retailers making a bet that San Francisco's worst days are behind them. So I love bringing you guys, good news.
Well, I gotta say, I love that accent, man. It's in Parlez-vous français, n'est-ce pas? Je m'appelle
Oh, look at
Lonnie.
that. You guys are getting cultural.
Ça va bien.
You guys are getting cultural.
I think my first suit was something in the YSL family that, they would brand them in the Macy's. You go to Macy's and it was not like the real, shishi version of the YSL. It was like the Macy's branded version of that. And it was a little too tight and a little too short and a little too shiny for my first office job. But, I survived.
These are good stories for us to follow because I think it bodes well to people's perception of long-term viability for San Francisco. And the U.S. needs San Francisco to figure it out and get it turned around. So, they've had a lot of crime in that area. They've had some retailers that have actually exited the space. I think H&M and a few others that were hit with the people that came in and broke the windows and stole all the stuff out. But it's a very high-end Louis Vuitton, Burberry. There's a lot of really high-end stuff. I think we even had a note here that luxury watch brand Omega opened a boutique outlet in Union Square. So I think there's some parallels here between San Francisco and Houston that maybe they're in a little bit of the trough right now, but long-term San Francisco should rebound. And if large-scale investors continue to make plays like this, I think that helps expedite that back to prosperity.
So turning to a trading alert that we had this past week takes us to a Georgia mall.
So we have to give credit on this one to our own Jen Spillane. And she came to us excitedly last week, or I should say yesterday, with this. And it has to do with the sale of a Georgia mall to Namdar. Namdar, you might recall, is one of the 2 or 3 big players in buying malls for pennies on the dollar. The other is Cohan. There was a couple of big news articles this week on Cohan and their strategy and what they've done around the country in acquiring this portfolio of a couple of dozen malls over time. In this particular case, this REO asset was the only remaining asset behind a legacy deal. The sale price came in, as you would expect, in that $10 to $20 million range. It was done via a property auction. You can look at this as the glass half full or the glass half empty. The glass half full is that the purchase price was about a third higher than the most recent valuation that the special servicer had procured on the asset. So the bond investors will get a little bit more cash back than they might have otherwise thought. The negative part of the story is that this particular sale price won't even cover losses to the B note. This loan was bifurcated a few years ago, and when the realized loss is taken, it will wipe out the entirety of the Hope note and a very big portion of the senior loan that is out there. So this is a story that our TreppWire readers will get tomorrow morning. And as a freebie for this week, if you send us an email, we'll send you this story as well, and you could follow up on some of the details.
So let's turn to multifamily. We have a quick hit that we wanted to cover.
Well, as our listeners know, multifamily has just been an extraordinary performer for the last couple of years. We're just seeing, as we database sales and so forth, properties going in 2021 and early 22 for 50%, 60% above where they traded for in 2017, 2016, 2018. It's just, the market is incredibly on fire, really everywhere. And to this point, the Nashville Post was reporting this week that 1200 Broadway was selling for a record price in Nashville. Intercontinental Real Estate is acquiring that asset for $295 million. It includes 300 apartments, about 65,000 square feet of offices, and 46,000 square feet, which is primarily made up of a Whole Foods. If you back out from the sale price, the proportion of the sale that was allocated to the retail and office parts, the sale represents about $600,000 per unit, which just crushes the previous record for multifamily in Nashville. So that's just more evidence of just what a great run multifamily is on. Endeavor Real Estate Group was the seller in that particular transaction.
Yeah, so I kind of fancy myself as a multifamily guy. I came up in the industry when I was just a young buck. And I remember thinking, $200,000 per unit sales, those were like the super elite California high-end multifamily deals. And now we're seeing 600,000 per unit trades in Nashville, Tennessee. It's very interesting. I think we could just parlay this back a little bit, Manis, to your question earlier about Dallas and Houston and maybe some of those other markets. I know Endeavor Real Estate Group was really active in Austin. They had a development there called The Domain, which was a retail mixed-use development. I think they still have some interest there. But if you look at Nashville, it's really Austin 2.0. So Nashville is kind of where Austin was, call it 7 or 8 years ago. And they're really starting to reap the benefit of that at this point. So there's been a lot of early money spent in Nashville before the broader spectrum of investors realized what Nashville was capable of. And those folks are being rewarded handsomely with these types of transactions. I mean, having Whole Foods as an anchor retail tenant really helps the sale, I'm sure. But 600,000 per unit for multifamily is just unheard of in what you would consider traditionally to be a secondary type of multifamily market.
Yeah, Lonnie, I would have flagged you as more of like a hostel guy or a YMCA guy, not a multifamily guy.
No, I was true and true multifamily, from ground up development, class A down to low income housing tax credit. I've kind of seen it all in the multifamily space. Next time we grab a drink, we can share stories, because I can just say this, on the whole, people are pretty gross. And when you work in the apartment business, you see very firsthand how some people don't take care of their stuff.
That sounds fun, guys. Count me out. Turning to shout outs, we have a number. Before I do, I did want to mention a programming note that our team will be at the MBA multifamily event in San Diego, February 13th through 16. And as you know, we always offer to buy you a coffee or a cocktail if you're interested. So let us know if you'd like us to plug you into our team that'll be out there, and we'll be happy to do so. So shout outs first is Steel City Dave, who sent us a shout out on behalf of Three Dog Night, Manis, not the group from the 60s and 70s, but
knock 3 times on the keyboard if you're listening.
Yeah, Shambhala. And said that the pod actually got them through the pandemic. Bob N enjoys our podcasts and plays them in the car, and not surprisingly, his kids roll their eyes, but they do ask follow-up questions. So, we still are providing an educational service. Kurt A had some words about a blog we put out recently about conduit issuance, and noted that conduit issuance is down 38% compared to 2019, as opposed to 2020, which was a fair comment.
So yeah, Kurt called us out on this particular thing. We put a piece out on issuance, and I guess in our zeal to, put out the most positive spin on what was kind of a disappointing year for conduit issuance in 2021, we pointed out that conduit issuance in that year was the same as 2020. Certainly a case of us putting lipstick on a pig. He pointed out that it was 38% lower than 2019. And I think that the narrative that we heard at CREFC and what Darren talked about last week, conduit has really been a real laggard in the issuance side. So, I got to give Kurt credit where credit is due.
And we had a number of people that were interested in the hotel cap rates piece that we put out. So if you hadn't received that and you'd like to, we'd be happy to share it. Jason D, Andrew G, Oz, who we have heard from frequently, Mordecai, Stephen H, Tim S, and Susie S, podcast t-shirt for her daughter. And if you want a t-shirt as well, let us know. We'll be happy to send you one. And Yanni loved the mention on Twitter about our Lauren Thomas pod. So if you hadn't had a chance to listen to that, we talked to Lauren about retail, in specific, some of the stories that she broke over the last couple of weeks.
I had a couple more that asked for our data. One was Deborah, a longtime listener, and she wanted our hotel data. And Joel, who last week we talked about the fact that he was on a cruise listening to our podcast. He was still on the cruise listening again, and he wanted the hotel data sent to on the cruise. And then I got a little bit of an alarming email from him later saying that the cruise line had filed for bankruptcy, and he was going to have to be ferried back from Bimini to Fort Lauderdale. So, we're going to have to get the rest of that story at some point. But thank you, Joel, for listening outside of the U.S. borders, and for reaching out, and for keeping us on your mind and in our hearts with the podcast.
So you guys know what's in a couple weeks, right? Yeah, don't say the Super Bowl. It's Valentine's Day. So just consider this a warning, Manus. No CVS presents for Valentine's Day for your sweetie.
I got to say that I am just a terrible, terrible gift giver. I always wait till the very last moment, never get quite the right bottle of wine or the reservation for the right place. It's just kind of a 30-year blind spot, and God bless my wife for putting up with me for all this time, because even grading on a curve, I am like a C- gift giver. And like I said, she's not only the brains behind the operation, she's also the long-suffering partner of the operation. But while I'm at it, while we're talking about nights out and Valentine's Day and so forth, I haven't given this plug in a long time. Remember to spend generously and tip your waiters and waitresses generously when you go out for dinner. Still a lot of lost income from people because of the COVID stuff, and if you can, be as generous as you can with those tips, and get that extra calamari and the after dinner drink if it's in your budget.
Yeah, I'll second that, man. The difference between an average tipper and a good tipper might be a couple $100, $500 a year. Like when it's all said and done, you can really help people get through some tough times. So, and Martha, I'm gonna skip over your segue there, because I'm gonna be at Craft MBA missing the Super Bowl and Valentine's Day. So I'll be in sunny San Diego. So we'll just move right along if that's all right.
What a romantic. All right. With that, we'll close. Thank you to our producer, Haley Keene. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or comment, send us an email to podcast@trepp.com and subscribe to the podcast with your favorite provider. Thank you for listening, and stay well.
All right.